Hey guys, how's it going? Right, let's start the video. Why is Greggs worth $2.65 billion? That's a billion with a capital B. One of my favorite things about investing is when I find an incredible business which is about as far away as I could ever imagine finding an investment banker. For example, one of my absolute favorite YouTubers is 𝗀𝗎. She's an investment banker who earns $300K a year. She was actually an accountant for an investment bank, so she's incredibly knowledgeable. But the idea of bumping into 𝗀𝗎 in Greggs is hilarious to me. Greggs on the surface is simply a bakery that offer affordable hot lunches and breakfast for people on the go. But the reason that they are unique and loved by people across Britain is they aren't just affordable, they are insanely affordable.
Last time you bought a sausage roll at Greggs, Prime Minister, how much did it cost? You've just told me that you're made of Greggs, so you must eat these sausage rolls all the time.
I don't know, £1.90, I have no idea.
It's a pound.
Pound.
Shops might appear basic. One of the reasons that they are so successful and valued at $2.65 billion today is that behind the scenes they have a system so advanced it rivals McDonald's, but more on that in just a little bit. Full disclosure, I'm an investor on eToro, and if you follow the link in the description, you can actually go to my profile and check out my stats and also look at my portfolio. And if you really want to, you can actually copy me, so you'll be copying my exact trades. But yeah, if you go to the portfolio tab, you'll see in there that I have a sizable position in Greggs. So that is why I'm so excited to be making this video today, but also why you must accept that I am biased on this particular position. Now, I'm going to be talking about three things. The first is why I think Greggs is an particularly exciting opportunity for 2024 and the rising interest rate environment. Then I'm going to be talking about the past earnings and the future earnings. But before we get into any of that, I want to explain why I bought Greggs, why I think it is one of the most exciting opportunities in the investing world right now. Completely unironically, one of the best businesses to buy in 2024. But to explain that, I first need to explain how the Greggs empire works. Put simply, what Greggs have done is turn classic bakery staples into mass market products. Nothing gets made on site, everything gets made at these enormous warehouses and then redistributed to Greggs' 2,400 stores. Producing their baked goods like this gives Greggs an enormous competitive advantage over all other bakeries, but not just bakeries, all other fast food giants. All the Greggs staff need to do is move trays of pre-prepared food into the shop counter windows, and when they are empty, lay a new tray there. Occasionally they need to put it in an oven first and then onto the counter. This means, unlike McDonald's, the staff at Greggs need absolutely no training. It also means they can serve so many customers with about 2 or 3 staff. I never see more than 2 people in there. The queue is always really long, but it moves as fast as the Nile. In fact, when you look at the Greggs business model of mass producing products at enormous warehouses and then distributing them to retail outlets, Greggs have more in common with Coca-Cola and chocolate companies than they do with their fast food high street competitors. The Greggs sausage roll is almost Britain's Snickers bar. Now, this is a really big deal. In fact, it might be a much bigger deal than some of you imagine. What do you think the best-selling chocolate bar was in 1961? I'll tell you. It was Snickers. Now, what do you think is the best-selling chocolate bar in 2024? Snickers. It didn't matter when the Berlin Wall fell, it didn't matter when 9/11 happened, and it didn't matter when COVID-19 happened. People still went to supermarkets and bought Snickers bars. The point I'm trying to make here is Snickers is an excellent lesson to all of those that think the world is a dizzying sea of constant change. It is, but only if you're not looking at people buying Snickers bars. This is the lesson I learned from reading Same as Ever by Morgan Housel, which is the follow-up book to The Psychology of Money, which I know some of you have read, but if you haven't read, this is one of the best investment books I've ever read. And its sequel is, I think, probably my second book, or it might be actually better than The Psychology of Money. Yeah, link to both of those in the description. Please give them a read. They're super easy to read. The point that Same as Ever tries to make is that instead of trying to work out what's going to change in the future, you should instead invest like Jeff Bezos and Warren Buffett, who try to look for things that will stay the same. It was Warren Buffett who pointed out that the #1 best-selling candy bar had been Snickers since 1961, but I find it more interesting that Jeff Bezos also likes to think about what's not going to change.
It doesn't matter to me whether we're a pure internet play. What matters to me is do we provide the best customer service? Internet, schminternet.
Let me read you a short paragraph from Same as Ever. Amazon founder Jeff Bezos once said that he's often asked what's going to change in the next 10 years. I almost never get asked the question, what's not going to change in the next 10 years, he said. And I submit to you that the second question is actually the more important of the two. Things that never change are important because you can put so much confidence into knowing how they'll shape the future. Bezos said it's impossible to imagine a future where Amazon customers don't want low prices and fast shipping. So you can put enormous investment into those things. Through this lens, Greggs have an easy mission: make food more affordable and more available. No matter how much interest rates may change, people's appetite for affordable, hot meals on the go is likely to remain where it is. Now, let's talk for 1 minute about macroeconomics that we will be going into in 2024. During the pandemic, the central banks lowered interest rates to historic lows. However, simultaneously, governments shut down society. So what was happening was people's bank accounts were being filled with printed money that had not been earned. All the while, the economy was just at a standstill. So all the energy that would have once been consumed was not needed, and we actually slipped into negative oil prices. Now you might think, what does oil have to do with Greggs? Well, unfortunately, oil has something to do with everything in our society. Almost all businesses on some level rely on oil. In fact, what's really hard to measure is how much interest rates actually affected any of this. As far as we can see, oil prices was one of the main impact factors for inflation. This is where we come back to Greggs, a company with no debt. Zero. So even if interest rates go to 10%, 20%, that will not affect Greggs in the slightest. The only thing that could potentially affect Greggs is inflation, and that would just affect their baseline costs. However, Greggs already, as we've explained, have an extraordinary competitive advantage over everyone else on the high street. The only other way that rising rates could affect Greggs' business is if the rising rates caused people to spend less in Greggs stores. However, I don't think the typical customer at Greggs is someone that has 5 mortgages. I think it's more the sort of day-to-day builder and commuter on the go. Not everyone in this country is going to feel the pinch of rising rates the same way. And if we've learned anything from Snickers bars, it's that consumer habits do not change dramatically during one recession to one war to one other crisis like a pandemic. In times where rising rates are sucking the oxygen out of the room, Greggs are standing there with an oxygen mask. Now it's time to look at the past earnings of Greggs. Now, in order to do a cash analysis to work out whether the price is fair, we need to look at their past earnings. Now, our goal here is not to determine whether we like the business. We've already established that. What we're trying to work out is how much are we paying for future earnings? How much of a leap does Greggs need to make in order to be worth its current price of $2.6 billion? Now, if we're just looking at last year's earnings and assume absolutely no growth whatsoever, then we can expect a return on investment in 14 years. That is, if I invested £100 in it, I would have £200 in 14 years. If the share price dropped by half tomorrow, then we could expect a return on investment even sooner, so long as we reinvested in it tomorrow. Now, if we use the average of the last 5 years, we could expect a return on investment of 25 years. Now, if we were to use an average of the last 5 years, obviously we're getting the suppressed earnings from 5 years ago, so we're expecting a lower number here. Now, 14 to 25 years would be a terrible outcome for an investment. That would mean that we are waiting a long time to have a return on our invested capital. If it takes this long to get a return on investment, including dividends, I would have considered this to be a failure. This is just a benchmark of which we can establish how much growth we need to see in the future. The issue with these stats is obviously they assume no growth whatsoever. So now let's apply a little bit of conservative growth to these numbers. given the simplicity of Greggs business, all we need to do, I feel, in order to establish its future growth is work out how many stores we'll have in the future and then times that by how much we can expect each Greggs store to make. Over the past 10 years, Greggs have built over 500 stores, going from 1,671 shops to 2,328 shops in July this year. I believe at September they said there were 2,400, but as a conservative estimation, I've gone with 2,300. To be honest, what's far more incredible than how many shops they've built in the last 10 years is that they've gone from earning £24,000 per store to £66,000 per store. Now, if we take Greggs' past conservative gross estimates and apply them to the future earnings, how soon can we expect a return of invested capital of 100%? We're going to discount the future growth in 3 ways. Number 1, we're going to assume that Greggs continue to build shops at a rate of 4% annually. Greggs have a median growth rate of 5%. Next, we're going to assume that the earnings growth of each store is 6% annually. Now, this is where I have done the biggest discount because really, Greggs have a median growth rate of 12% annually for each store. 12% is insane. This is really what has been helping the Greggs business grow. Next, another massive discount is we're going to assume that people in the future are only willing to pay 10 times earnings, while currently they're willing to pay 20 times earnings. Now, if we use these conservative figures, we can assume that we are going to get a 100% return on invested capital, doubling our money by the year 2030. But I just want to give you an idea of how just changing one of those things make it more likely that we'll see that number far sooner. So let's say, for example, the price to earnings remains at 20. Well, then we could see a return on invested capital of 100% by 2026. Now, as we've gone into, the thing that I really love about Greggs is it has relatively zero economic uncertainty. I'm absolutely certain the people that shop at Greggs today will want to shop at there tomorrow. And along with the fact that all their growth is fueled by pure hard cash, and they know exactly where to invest their money. More stores, better stores, Uber Eats, all these things are going to make food more affordable and more available to the people that love their products. But I'll know when I'm wrong. If Greggs had not doubled in value by the year 2030 or sooner, then I would have been grossly wrong about this investment. But the beauty is there's relatively no downside risk, given the fact that the biggest risk to this business is people paying a lower PE. But the thing you need to do if you really want to be rich is